A lot has changed since last week when JPMorgan advised investors to hold more stocks than bonds, load up on bank shares, and buy oil. The Greek debt crisis is, of course, one step closer to resolution, but the U.S. deficit is no closer to being plugged after Republicans abandoned bipartisan talks yesterday. And oil, of course, is gyrating after that decision to release 60 million barrels of stockpiled crude. Here with us this morning is Jan Loeys. He is the managing director and head of global market strategy at JPMorgan Securities. Jan was previously a senior economist at the Federal Reserve Bank of Philadelphia. Jan, wow. So let's turn our attention to how you play the markets now. I just described for everybody what you recommended last week. Do you still feel the same way? Overweight equities versus bonds, still long oil after that move by the IEA yesterday?
Well, the first part, yes. I mean, things are very volatile, but they're on the margin a bit better. We had all kinds of event risk around Greece. Huge risks later in the year. They're at least they voted through the confidence vote. We're guaranteed pretty much that the austerity plan will be voted through by the Socialist Party. The real work is afterwards. So that's not really where the big event risk is at the moment. We had a long oil because rising oil prices were the big threat. And when we really get down to it, Greece is not the real story. The real story is the global economy was weakening, and a big force behind that was rising oil prices. So the long oil was really a hedge on that. I don't think we need it anymore at this point.
So you would just abandon the oil trade altogether, or would you go short crude?
We probably will be recommending today to be on the short side. But it is for an investor that is still thinking about massive macro risks, having some form of long exposure in oil to options. Basically saying there's still some kind of an event risk around oil. So oil is a major threat.
Now, when you say that, I just want to understand something here. A week ago, WTI was trading, I'm only talking about U.S. crude futures, was trading at $93. Today, $91.25. So not a dramatic difference. No. So are you saying, in what you're describing to me, that the IEA's move is an indication that these major oil-consuming countries are prepared to keep crude more or less around that $90 level, and we will not see it tick back up above $100?
No, we're saying shorter term. The IEA, basically the major consuming nations, are telling us that the rise in oil prices was an unbearable threat. And, they've been running out of the ability to use monetary and fiscal policy.
Right.
The only thing really left.
As a sort of a backdoor stimulus, keeping oil prices lower.
We're calling it IEA 1. QE3 is not available anymore.
And there is more oil stockpiled. But if the market forces, look, is this going to happen? Is the market going to start to go to war with the IEA? And ultimately, is there enough stockpiled oil to keep oil prices down? Because if the supply-demand trends are such that oil is going to resume its upward course, it would continue to remain a threat to the global economy, would it not?
Oil will ultimately resume its upward course in line with global demand. So if we have an economy that is indeed bouncing back in the second half and into next year, demand will be increasing for oil. I think the IEA measure is a temporary measure. This was currently clearly a problem due to the lack of Libyan supply, which is pushing oil prices up.
Let's quickly turn our attention back to stocks for a second. We are about to see stocks close out, U.S. stocks, of course, I'm describing, close out a second week of gains. Yes. Is that a trajectory you think we can see continue, or between now and the end of July, while there is no resolution on the U.S. deficit problem, they're going to be range-bound and bouncing back and forth and maybe even resuming the downward course?
I mean, we think through the summer, we'll see in a very volatile manner stock prices being up. The big issue is not so much the U.S. deficit or Greece. The big issue simply is the world economy rebounding in the third quarter, as a lot of analysts are projecting and are anticipating. So far, it's all forecast, not fact yet. We need to see the facts coming through, and it is going to be industrial production, PMIs, export data, all through the next 1 or 2 months. We'll see the sufficient evidence there that we'll have this rebound in the third quarter. That's the real force.
All right, Jan, great to have you here in the Inside Track. Jan Loeys, head of global market strategy at JPMorgan Securities.